Hello. Hi, everyone. Hope you liked the last video on procure to pay, which I covered in English. And in this video, I am going to cover order to cash O2C cycle, which is another very important mega process. So as part of this video series, we will cover all the important processes in internal audit. So in the first round of videos, we will cover what the process is, what we can audit, what all risk and controls are there. And in the second round, we will again revisit these processes, and then we will cover what kind of observations can be found. I can share my personal experiences, and whatever comments or queries we will get from you over LinkedIn, over comments in YouTube, those also we will cover in those second round of videos, so that it is more interactive and you can also get answers to your queries. Now let's get started with the video on order to cash. Before that, let me share a brief introduction of myself. I am Gaurav Goel. I'm a chartered accountant and a certified internal auditor by qualification. I have been doing internal audits for the last 8.5 years. I have worked in big four audit firms. Also, I have worked in multinational corporations in the internal audit domain. I have worked or audited for clients across industries, across geographies, and also I have covered by and large all the relevant processes that are there in internal audit and also related fields. So I've done SOX testing, IFC, ICOFAR, SOP preparation, all those elements, some consulting element I'll also try and bring in the videos. Now let's talk about what briefly we would be covering in this video on order to cash. So firstly would be pre-sales activities, like inquiry from customer, bid submission, negotiation, what all happens there. Then we will move to contracting with the customer and receipt of customer purchase order. Basically, like I said in last video on procure to pay, how we as customers send a purchase order to our vendors. Similarly, from our customers, we will receive the purchase order. So receipt of customer purchase order, what kind of elements are there in the purchase order, what are the payment terms, what are the credit terms, revenue recognition trigger, terms and conditions. So we'll also cover contracting elements. Then we'll move to the sales order part of it, in which we will cover the customer master, price master, product master, all those essential data sets which are important. Then we will move to order fulfillment or actual delivery, wherein proof of delivery would be important. So now you see that we are covering it after P2P. So the perspective has changed. Now we are acting in the we are stepping into the shoes of vendor, and how what all compliances would be required, what all controls would be required from the supplier basically. So that is basically the different perspective of P2P you will see in O2C. Um, and then we'll also talk about discounts, sales incentives, invoicing, account receivables, in which we will cover bad debt, provision for doubtful debts, sale of receivables. Also, we'll talk briefly about IFRS 115, which is on revenue recognition, order to cash process for services. We'll also talk about order intake, order backlog. You might have heard in news for certain companies that they have a good order book of such and such value, which will help them sustain for the next such and such year. So we'll cover that. We'll also cover collections, which is a very important topic. And cash management, and then sales return and warranty, and then finally we'll briefly try and conclude. So let's straight away jump to the first topic, which is pre-sales activities. So what happens, it's not like customer, you have started business and customer would know that you exist, right? So you will promote yourself, you will reach out to your target customer, tell them what all goods and services are being provided by the company, and then you try and always check if there is a requirement coming from the customer. It can be either push marketing or pull marketing. So marketing and sales go hand in hand. So marketing tell that what this company does, and then sales identify a particular customer and then target what business we can get there. So then this is pre-sales. So once the customer is aware what all goods and services you provide, so there might be an inquiry coming from customer, which is like RFQ sent by the company to its vendors. So similarly, that RFQ is basically an inquiry from customer for you. Then based on that, the customer will submit a bid. So what all technical requirements were put in by the customer, saying I would need this and this, you provide all these documentation. There's a document called SOC, statement of compliance, which is filled in saying that you had these 50 requirements. Against this, I have this one is complied, this one is not complied. What is the status? What all documentation I have? And then that is all technical analysis. And then for commercial, I provide my bid that for this item, I will charge this much price. This will be the payment term, and all those details we provide. And then negotiation happens. So in P2P, I was mentioning that procurement is involved to check whether the prices are correct. So it's not like the first price the vendor asks, you straight away compare and select. So you again reach out to them. So now when the tables are turned, are basically customers will reach out to us saying that, hey, you have quoted this price, but I'm getting better from someone else, or if you can give an additional discount, maybe a volume discount, or we will give you good business in future, so please help us with a discount related to that. So all those are taken into consideration. Companies give additional discount at time, they say that this is the last and best offer, something of that sort. And then finally once everything is settled, then the process moves on to contracting, basically getting into a contract with the customer. So in your mind, what you can do is every now and then you can stop and then compare, okay, what happened in P2P, and then the role reversed, what is happening in order to cash. So now the contracting is done from the supplier side. In the contract with your customer, you will also try and secure your rights. You want to secure and make sure that the contract is beneficial to you. So then you clearly define that what is the payment term, when I expect to get the payment, at what stage can I say that I have delivered the good or services, when would it be due, if there is a dispute, how it would be resolved, and all those kind of parameters. So generally there is a standard contract template. So we need to ensure that is signed, and if there are deviations to it, then approval or review from let's say the teams like legal and compliance, or commercial legal teams. So that would be required, right? Then once the contracting is done, under that, customer will start sharing the purchase orders. Based on those purchase orders, we will again see that whatever purchase orders are received are in the name of right entity, the delivery locations are correct, and all those details are correct, and customer is onboarded into the system. So we'll come to that in the master, because sales order is the stage wherein all those details would be required. So we'll cover that there. In contract and in PO, we will check whether the payment terms are aligned, what is the credit limit, how much credit are we allowing the customer. So it's not like if the deal or transaction is for $1 million. So the credit limit might be $1 million if it is supposed to go in chunks. So it might be, let's say, 200K dollar. So we say once you clear this, we will send the next round, or payment cycle is monthly, no, or quarterly. So whatever it is, you need to plan that well in advance. You need to forecast how, at what frequency you will get the cash, so that you can plan it better. And then we also see what would be the revenue recognition trigger. Like I said, at what point in time will I consider that my obligations are fulfilled as a supplier, and then I can raise invoice to you. Then we will also then move to other terms and conditions covering, let's say, bribery and corruption, for that matter, any legal limitation of liability. So those kind of topics would be important, for you to see that whether the contract is properly signed or not. Then we move to sales order. In order to update the details, because purchase order is a document which is received from customer's end. So you need to document that in your system, in your ERP. So what would you do? You create a reciprocating sales order against that customer purchase order. For that, you would need details of customers in your customer master, which is sitting in SAP or Oracle or any other ERP. So if the customer is new, again, before onboarding a customer, it's financial due diligence, basically some basic checks from compliance standpoint, from commercial standpoint, whether we should do business with this customer or not. Those would be checked. Then details would be obtained, banking details, who all are the authorized signatories. All those details are obtained. Those details are updated in the customer master, and this customer will start reflecting. Then what items we are selling to the customer. So product master would also needs to be there in the system so that we can map the items in the customer PO with the sales order items. And then there's a one-to-one mapping that these all items I'm going to supply. And then there's a price master for every sales item. There would be a price at which it is sold, and then there would be subsequent discounts on it. So once all these details are there, the sales order is punched. So you need to compare and make sure whether the purchase order received from customer and sales order entered is matching or not, whether they are tallying or not. At times, due to practical difficulties, in order to ensure better tracking, customer purchase order might be split into multiple sales order, or multiple purchase orders could be combined into a single sales order depending on different parameters. Then once all these steps are done, then the actual execution happens, which is basically order fulfillment. You start delivering the goods. Before delivering the goods, you make a plan, you make a schedule, you update that schedule in SAP or in Oracle. Based on that, if something is to be manufactured, all those details are updated, budgets are updated in the in the background, so that the manufacturer knows what to deliver, when to deliver. And then those goods, once finalized, quality check is done, everything done and dusted, those are dispatched or shipped to the customer. So in this entire thing, we will, in order fulfillment, let's say if goods are going, so there is a delivery challan, or we say proof of delivery, which is obtained from the transporter or from the courier company, saying that, okay, hey, we have received the goods. Customer is saying we have received the goods, they are okay, quantities are matching. And based on that, we can raise invoice. Or at times what happens, due to local laws, the invoice is also sent along with the goods, and then the invoice is accepted by the customer. And then we wait, okay, that from today, now the time is ticking, and then I need to collect my money after such and such time period, right? Then once this order fulfillment is done, at times what happens in transportation, you might have to incur demurrage charges. Customer took too much time to offload the goods, or the trucks were waiting in your premises, in your warehouse, and it was delay on your part, and the logistics service provider has quoted for the duration of that supply. But if there is any abnormal delay on the part of customer or on the part of supplier, in both the cases there would be a demurrage or penalty which might be required to be paid, right? So all these additional expenses needs to be tracked, and all these logistics related expenses also needs to be tracked, whether it is paid in accordance with the contract or not. Then we talk about discount and sales incentives, which is a very tricky area. So there could be credit notes issued, there could be some vouchers given to the customer, there could be volume based, there could be periodic discount. So whatever discounts are there, what you can do is you can go back to the customer GL and see all the debit entries. And then you might select a few and try and understand what is the reason for this deviation. And also you can see whether that reason is substantiated or validated through a valid contractual term or not. Before agreeing to do business, we might have planned that we will get this much margin from this business. On this much volume. If volumes are reduced or if margin is reduced, then it needs to be analyzed why this is happening. And if it is as per the contract, then it is okay, because the contract was also approved. There might have been a go ahead given by the management that, okay, you can go ahead and sell at this price. If prices are reduced, if there is a fluctuation in margin, it doesn't make sense, right? You are stucking your working capital if you are not getting money on time, or if you are not getting sufficient margin, it doesn't make sense to do business with that customer. So that is tracked and that is monitored. And discounts are a very good way of passing on money to the customer. So you need to make sure whether that is as per the contract or not, and you need to track that very consciously. Then even the sales incentives, sometimes what happens in certain businesses, the sales incentive is given to the dealer, to the distributor, and even to the sales team. And after a certain point in time, additional discounts are given to get more business, or the sales are returned. But then we need to make sure that those incentives are recalculated accordingly. There is a provision for sales incentives which is also calculated at a periodic level to close the books. So you need to see whether that closing or that provision was correctly calculated. How would you do that? You can see all the assumptions, you can see all the sales data that is taken to calculate that prospective provision for incentive, and whether that was correctly done or not. And you can check in the past whether that has been correctly posted or not. Then comes invoicing. So we need to make sure whatever is supplied has been invoiced, the rates which are agreed in the contract have been updated, the quantities are correct, so that there is no revenue leakage as such. You also need to make sure all the tax related details and whatever statutory requirements are there with respect to invoice are also correct. So invoice should be matching with the customer purchase order or the sales order that we have. Then let's talk about account receivables. Once the due date is there, you need to track what all customers are not paying. If the contract says that you need to levy interest, so in certain cases, as a business decision, management might decide not to levy interest. So you need to see approval for that. If they go ahead and levy interest, you need to see calculation, whether the interest was correctly calculated and whether that was charged. Properly on a timely basis and whether that was recovered from the customer or not. If there is substantial delay, then based on the past trend or different other parameters, a provision for bad and doubtful debt is also created that we are not sure and whether we'll get this money or not. That might be taken into consideration at the time of preparing or planning as well. So you need to compare those things and see whether the provision is again appropriately approved. What you can do or value add you can do is based on your data analytics. You can find that which all are the top customers, which is the frequency, which is the geography where this provision value is much higher. Or you can also check if there is significant aging for a particular customer, whether the volume, quantity, amount of bad and doubtful debt and provision is also matching with actual aged receivables. So let's say um, if I have 500k USD, 500,000 USD in my provision for bad and doubtful debt, but aged over 2 years, I have bad debts every year. I have more than a million. So I would say there's a shortfall and maybe the mechanism that we are using is not making sense and vice versa. So you need to ensure whether that is making sense or not using your data analytics. And also you can try and identify for the management that, hey, we need to focus on these customers because these are really not paying on time and they're trying to use our money for their working capital. They want to get the goods from us, but not pay us on a timely basis. So that needs to be tracked, and whatever bad debt is written off, that also again then needs to be monitored properly, and needs to be seen whether that is appropriately accounted for in the books and records or not, and whether appropriate approvals were taken or not. Now, this provision for bad and doubtful debt is today these days called expected credit loss, which has a different calculation mechanism. So I visited this point in last video on procure to pay as well. You need to make sure whatever accounting related technical policies or general guidelines SOPs are there. So you need to read through them in detail. You need to read through the contracts in detail so as to understand what all complications are there, and contractual compliances are an important aspect in both procure to pay as well as in O2C. So you need to see whatever is there in the contract with vendor, in the contract with customer, those are aligned and actually implemented. If we need to submit some report to customer on a periodic basis, whether we have done that or not. If there are certain SLAs which need to be monitored and which needs to be adhered, whether we have been able to perform as per that or not. If not, then what all root causes were there and what we have done to correct that so that there is no penalty or liquidated damages from the customer in the future. So we need to track those aspects as well. Then you need to study IFRS 115 on revenue recognition in detail so as to understand what would constitute a separate contract, what all would be the performance obligations, how would you distinguish between the value, whether it would be point in time revenue recognition over a period of time revenue recognition. For accounting, you need to be very conscious. Basically, you need to see accounting policies are being adhered or not. For IFRS, what is tricky, if I give you one example, you purchase a refrigerator, for example, right? For refrigerator, you pay 200 USD. Now, for that refrigerator, once you've bought that, you have paid upfront, but the company cannot recognize that entire revenue of 200 USD at a particular point. Why? Because the refrigerator is also coming with a 5-year warranty. So what they would do, they would split this 200 into two buckets. The price shown to customer was 200, but then the goods, the fair value for those goods would be 180. and then the 20 would be for warranty, for example, and then 180 is booked the moment that refrigerator is sold or delivered to customer, and then the 20 is split into 5 years, and every month or every quarter or every year that revenue is recognized. So this IFRS 115 is very critical. You need to make sure that all these steps are followed properly and accounting is done properly. um, um, there is a in within O2C for services, it is critical that you are tracking your milestone, you are tracking whatever you have delivered, you have invoiced to customer. Again, from consultative perspective of it, you need to see um, whether what is the lead time for me to start business, for me to deploy, whether I am meeting my SLAs or not. What is the lead time to invoice the customer, how much time customer is taking to give acceptance for service, whether that is meeting with what I have agreed in the contract or not. If not, if customer is habitual of delaying acceptance, and I am not able to raise my invoice on a timely basis, or customer is not paying on timely basis, then you might then ultimately need to decide if we need to take any action which we can contractually take. Order intake and order backlog is something which is again which comes at a very primary stage, I would say. Why? Because when we receive customer purchase order, there is a order intake booked, that this much order I have from customer, which is a number which is reported also as part of your financial statements. You say that I have a order, confirmed orders from customer, through which your investors can also understand that what are the future prospects of the company, what is the order backlog at this moment. So order intake is basically whatever new orders you have received, and backlog is new minus delivered, plus whatever previous backlog was there. So you will get a new backlog. So this can activity is done every monthly, quarterly, or annual basis. Um, these numbers are also important to track, and based on the order intake, the sales incentive of the employees and certainly the dealers and distributors is also calculated. Um, in collections, I think we've already talked about account receivables, bad debts. There's a topic called sale of receivables. So you can discount the invoices if you think the lead time is too much and you need working capital, or you would be able to make better use of that money. So you can give those invoices, and bank can collect those invoices later on. Bank can give you the money at that particular point in time. So that is called discounting or sale of receivables. Um, and you get the money and you can use it for generating more cash. So that is a conscious call where you want to discount. It could be with recourse, wherein if customer doesn't pay, the bank will ask you to pay. It could be without recourse, wherein customer or bank cannot force you to pay, then it will go back to customer and ask for payment and follow up with the customer, and if needed, file a case or liquidation case against the customer in that case. um, so without recourse is preferred, but that again will come with a cost, right? Sales return is another crucial topic, and warranty is another crucial topic. Why? For sales return, it's not about accounting. I mean, what kind of a debit note I've given, whether that value was matching. It's also important to understand what are the reasons for the sales return, what I can do to reduce these values or these quantities of sales return, whether my quality was incorrect, if any rework need to be done, and then this would be addressed. So what all cases are there, and that is linked with warranty also, right? If something is under warranty, again similar set of analysis you will do. You calculate a provision for warranty, that how much expenditure on warranty would be there based on past trend, and also you would calculate revenue, like I said, and then on operational aspect of it, you would see why I am getting these problems in my equipment. In warranty, we will see what all the top 10 defects, what I have done to correct those defects, and after those preventive or corrective actions, what is the new trend for those type of defects, so that we can improve our quality over time and reduce these additional expenditures on warranty and sales return, because there would be logistic related expenditure also, which is called reverse logistic, basically collecting the goods and from the customer place to your place, getting it corrected and then delivering again. So those costs also needs to be curtailed and could be monitored better. Now, where all risk is lying, risk would be contracting with customer with whom we are not sure if we want to do business. There is risk of anti-bribery, anti-corruption, wherein money can be paid to customer to get a business which is unethical, and at some point in time, government might put restrictions on you. So we need to see how we are dealing with customers, the employees, sales and employees, marketing employees, how they are dealing with the customers, if they are providing any fancy gifts, lavish meals, drinks to the customer. So that also need to be checked and put in and compared against what all company policy allows them to do. In certain cases, you can also challenge whether company policy is making sense or not. Then you need to see again contractual compliances are being met, how we are ensuring that we will be able to deliver whatever margins we have committed, um, whether we are actually getting those margins or not. That also is something which we consciously need to track and monitor. As an auditor, whatever things I've said that need to be done, you need to ask the management whether you are doing something on those lines, what is the policy saying, and what is the actual implementation, and then you need to find the gap between these elements. Like we did in the last video, here I've explained the process, where all risk could be there. There could be underbilling, there could be excessive discounts, there could be um, uh, a delay in payment from the customer, receiving payment from customer, not following appropriately with the customer, the balances which we are saying that we have with each other not being reconciled on a timely basis can also lead to dispute. There could be certain cases with the customer, something we've done given to them as demo, they might be selling it further or utilizing it for commercial purposes. That again could be a risk. So you need to see all these aspects which would basically or primarily derive from your contract, from your policies, and from your practices. So you need to make sure that those things are aligned. Now, let's again do this. You put your questions, your queries in comment. I will again make a part two, a follow-up video on order to cash. In that follow-up video, we will address your queries. I will also cover some observations that I have found in the past. And with those observations also, we will discuss in more detail some more risks and controls which could be relevant for order to cash process. I hope you liked this video, you found it relevant, you found it useful. And if you think that this could be useful for some other colleagues or some friends, please feel free to share this with them. I post these videos link on LinkedIn also, so you can follow me there, and we can connect on LinkedIn as well. Stay tuned for more such informative videos, and anything you request, I'll try and make some videos on those topics also. And see you for the next video. Bye bye.